If you work a day job and you own or you want to own a short-term rental, boy, do I have the tax strategy for you. So I'm sure you've heard or you've considered what is called the short-term rental loophole. So for those of you that don't know, you are actually able to rent, and if you do this right and if you play your cards correctly and you move the things that you need to do on your personal taxes and how you manage everything, you're actually able to offset and use as a tax shelter this short-term rental loophole to offset your W-2 income or whatever income you have from your day job. This is a strategy that is one of the most common and one of the most advantageous strategies that homeowners, and especially for those that don't necessarily have a realtor license, that can use to offset some of that income that is brought over from your day job, from your W-2, right? And this is all done legally, and it's but with a nuance, right? That it's legally, but you have to do it correctly. Okay, there are certain rules that you need to follow so that this actually kicks in. So today, what I want to talk about is how this tax shelter can actually offset your W-2 income. I'm going to give you an example of how one of my clients was able to save somewhere upwards of $65,000 using these strategies. Okay, and completely legal, completely ironclad to audit or anything. And so with this video, what I want to do is I want to talk about what works, just how the rules work. I want to talk IRS tax codes, and I want to just show you how the loophole is presents itself with the different nuances that may come with it, and also more very important IRS flags that can cause you trouble if you don't do this correctly. So, hi everyone, my name is Julian Gonzalez. I am a managing partner here at Upfront CPA. I've been for many years worked with entrepreneurs, business owners, and my main focus is tax advisory, tax planning. Make sure that as an entrepreneur, as a business owner, you don't pay one penny more than what you should be paying. Okay, and I always talk to my clients, there's so many opportunities, so many strategies that are given to you that all you have to do is just take advantage of them, do it correctly, follow a few steps, and you will be good to go. You'll be able to save many thousands of dollars, tens of thousands of dollars even if used correctly. If you follow my channel, I've talked about different strategy. I've talked about cost segregation. I talked about long-term short rentals. And now it's my turn to go over short-term rentals and what they can do for you. So I just want to put a disclaimer that this is for educational purposes only. Everybody's case is different, and you should talk to a professional to see your independent case to make sure that this strategy works for you. If you want to follow us and you want to book a consultation here at Upfront CPA, we'll be more than happy to go over your situation and see if a short-term rental is something that you can use to save taxes. Just go to our website, book a consultation. We're getting ready to set up even some freebies in terms of tax advisory sessions that we're putting together. So we're coming up with some new exciting stuff. So definitely stay in touch for that. So what's going on with this short-term rental? Okay, so and just kind of taking a step backwards. What we're doing here is what I've spoken before in other sessions such as this one. It's the passive and active income situation, right? And just to going back to that whole scenario and what's happening there, it's the IRS differentiates passive versus active income, right? And kind of like it's a self-described thing, right? So active income is your day job, is your W-2. It's what you're actually actively working on. Passive income is those that you are not actively part of that business, but you're generating income anyways, right? And that's, it could be such a, if you don't do the strategy, it could be a home rental because you're not involved in it at all. It could be, ownership of stocks, of bonds, stuff like that, that obviously you're not a day trader, so it's passive income. So what happens here is the only way to offset passive income is with passive losses. Or passive losses, they just kind of offset each other, right? It cannot cross over your active income. So if you have a bunch of losses, and I get this a lot, clients call me and will say, hey, Julian, I have good news. I lost a bunch of money on the stock market, so I can now offset my W-2 income. Unfortunately, that is not the case because the income from your W-2 is active. Your losses from the stock market is passive. They cannot cross over unless you do certain strategies, such as the one that I'm going to talk about today. So, what do we want to do? So, the first thing is, what can we do, right? How can we do the strategy correctly so that we can do that crossover thing that I keep talking about, right? So I want to go over kind of like the high level how the strategy works, right? So as I mentioned, passive by default. So what are short-term rentals, right? Let's begin there. What is short-term? What's the difference between I own a home, I rent it. What the hell are you talking about, right? So you have two options when you rent, right? And it's clear. So you can either set it up for long-term rental, which is, you just rent it out for the yearly contract, 6 months, whatever. Or you can do the short-term, the Airbnb, the VBO, whatever app or booking.com, whatever you want to use for your short-term rental. So they are different in, number one, the average stay is 7 days or less. So for every time that somebody rents your home, when you make the calculations, if it's less than 7 days each, booyah, it's a short-term rental. Okay. In some cases, it's 7 to 30 days with substantial services. What does that mean? Let's say that you do a rental, but you do other services as part of that rental. Kind of like sort of like a hotel type, where you can do like room services. It's just additional services that you include there. There's some room there, but we gotta be careful because you gotta meet the criteria, right? And then the big one is that you materially participate. This is the one that kind of I've seen the biggest slip ups, okay, in the material participation, okay. So there's and we said we're gonna talk code, right? So on the Reg 14691 1TE3A, okay. Short-term rentals can be treated as non-rental trade or business, so losses can be non-passive, ain't available to offset W-2 business income. Boom, straight English. Just read it for you. That's exactly what it says. If we're able to turn that short rental and identify it as a short-term rental with all our support, all our backup, guess what? We're able to do the crossover that I keep talking about. The magic crossover. That's the one, that's the money shot that's just gonna really make a difference on your tax return. Okay? So if you're if you're a guest, less than 7 days you're involved, the IRS will treat it sort of like a hotel type of thing, and then you're gonna get the big tax savings that I keep talking about. Those big beautiful differences that we're gonna send your report. We're gonna show you. You paid all this amount last year. This new year, this is how much you're gonna save. You're gonna love it. So now, average day and the material participation, right? So you have to calculate. Basically we have to do a couple things, right? The first one is we have to do the calculations, right? So we have to calculate average days. So what we do is we do the math. We put the total nights rented plus divided by the number of bookings. Okay, so it's a simple math, right? So total nights, just get your Airbnb or your nights, your booking.com, whatever it is, you calculate your nights, you add them up. And this is something you can proactively do as well, right? When you put your rentals up for the rental, for the bookings, you can select the timing. Right, you can make sure that you put in the timing so that this calculation works and you don't go over, right? But the math is simple, right? So numbers of total nights rented divided by the number of bookings. Boom. So what are we aiming for? Again, 7 days or less. We want to get that number. That's your average during the year. So we're gonna do that math. And then whatever number comes out, that's what we do. That's the number you're gonna get. That's what you're gonna base your decision on, or kind of identify if you kind of fall under the short-term rental. So as I mentioned earlier, what do we do? So okay, Julian, in December, it's December 30th. I do the math. It comes out to 8. And unfortunately, I did not do any audit services. I don't have anything. So that's why we at Upfront CPA, we always advise to do ongoing, to just have an ongoing relationship with your accountant. Don't just show up at the end of December. This is what I have. Let's work some magic. Basically, what's going to happen is you're going to put your accountant in a tough spot to just have to tell to just kind of break the bad news to you, or hopefully you find some lucky way to just kind of get over the hump. But don't risk it. Just do ongoing work and consultations, or get on a retainer where you can just kind of go on proactively make sure that you're covered. Okay, so I mean, just think about it this way, right? So if you're spending a few $1,000s to make sure that you're compliant, where you're gonna save hundreds of thousands, it's a no-brainer, right? It's the difference there between just considering something an expense and just thinking it through, where it's an actual investment. Okay, I know it's tough to do that. I know it's hard to just think of it, when you call your accountant or your CPA, say, hey, look, I'm gonna put you a retainer for this much, and as part of that retainer, your books are gonna be clean, and we're gonna go over all your strategies. We're gonna make sure we're current, we're compliant, that we have everything ready to go. So when we come in December, we may able to meet just to kind of just have a rundown, make sure everything is done. And by April, we're filing taxes. You don't have to worry about nothing. You don't even have to worry about the IRS. You don't have to worry about, maybe even extension. I may not, a lot of our clients worry about extensions. You may not have to worry about that. You are good to go. We see the difference there in terms of our clients, their peace of mind, their stress level. It's an investment on you, on your company. It's good all around. So we talked about the average days, right? The math, right? So now comes the other fun part, which is the material participation test, right? So just kind of temporary. So this is how it works, right? So we got the first one is the 500-hour test. Okay, so if you spend 500 hours plus on the activity, okay, so think about it. That's a lot of hours. But it could be anything. It could be doing laundry. It could be setting up the bookings. It could be doing errands for the rental, just doing repairs, doing the logistics for the different things for work that may be needed for the rental to go through. All of that counts, but that's the first one, right? 500-hour test. If you hit that number, you're good to go. Okay. Substantial all participation. You do basically everything. So that would be the ideal, right? So obviously there's some risk there because we gotta analyze whether you have the time to take care of all the work that is necessary to keep this thing afloat and make sure that you're kind of providing the right service so you may continue. But if you're able to work that out, that's number one, right? So then 100 hours plus, no one more than you. So if nobody does 100 hours more than you, then that's the most popular short-term run that the strategy that is most heavily involved, right? So that no manager cleaner is doing more work than you, right? So you just kind of put that threshold at 100 hours, where you kind of put that differential between you and the next level of work, and you're good to go, right? So again, all of these, I know it sounds sort of like, but it sounded like the short-term rental was easy, and now you're putting all this hoop. I mean, it's work, but it's an investment that is gonna pay off big time at the end. And again, this is another one that, for example, a firm like ours at Upfront CPA, we work with you to make sure you're maintaining that you're complying with all of these requirements that are needed, right? At first, it sounds like, it's a lot, 500 hours, 100 hours. Like, what is that? Here at Upfront CPA, we work directly with our clients, and I'm sure a lot of CPAs, you don't have to work with us, just work with your own, and I'm sure they're able to provide you with the type of service where to them, they're so experienced that they can just kind of make that easy and simple for you. At Upfront CPA, that's what we do. You won't believe how many clients at first, they think that this is so hard, so difficult. Just one meeting with us, they're booking, we're putting together the tax advisory plan for them. The next day, they're up and running. The following year, they can't wait to just thank us and hug us and whatever they want to do, because of all the amount that was saved. And then not only that, you're also setting up yourself for a better future in terms of, now you have an asset, right, that you can provide later for your children, that you can just kind of pass down. It's an investment. It's beautiful. Everybody likes it. So one thing that is big here, though, and that is documenting everything, right? So, when we're talking about, the work that you're doing, and again, this is the type of thing that just takes time getting used to, right? So, if you're doing repairs, if you're doing laundry, if you're doing even landscaping, whatever you're doing for the rental, we need to be able to document it. Okay. So just keep a log, guest communications, pricing, cleaning coordination, marketing, all of that, all of those things are, if you do things right, it's easy to track it, right? Not easy, it's uncomplicated, right? You just gotta, just follow the criteria that they ask, just, keep a simple log, just make sure it's current, and you should be good to go. Okay. It's it's one of those that we always recommend here at Upfront CPA that you keep track of everything, right? So we always start from the principle that transparency is key. That's what we call upfront, right? So with that being said, once you're working with us, and I'm sure even your own CPA can do this, is once you kind of start getting in that flow where you're used to providing documentation, you can start thinking ahead, where you're in a situation where you're working, let's say, a with a marketing firm, or you're doing some marketing for the rental or whatever business that you're working on, it just sort of becomes second nature, right? To what it's like to provide documentation, logs. You sort of like keep track of what you're doing, so that if someone comes knocking on the door, if the IRS asks, show me, you want more than just a guess, right? You don't want to be guessing. You don't want to just kind of also put your situation that we've seen here out for a CPA, where you're just like, oh, I paid an accountant that I only saw once a year. I thought he was doing the work. You can't imagine how many times we've seen that, and it never works. It's always a mess to have to clean up later. So we talked about the hours, the average time. We talked about the participation hours. Now I want to show you the example of the $65,000 tax saving example, right? From one of my clients, okay? So it was a W-2 earner in tech. It's popular these days. Influential YouTubers. That seems to be the industry that's one of the most thriving industries at the moment. So clearly a high bracket. It's in the it's upwards of the 30%. So buys an Orlando short-term rental, right? And we say Orlando because this is our area, right? But this applies to really anywhere in Florida. So it was somewhere about $700 all in, right? Including building, furniture, closing costs, all of that. Somewhere around $700,000, right? So you must be like thinking, well, $700 is quite an investment for a short-term rental. But listen here, you stick with me, because you're gonna like this. Okay, so what was the first thing we do? We do the one strategy that is always the one that is the king, right? Is the one that is the alpha male, is the king of the jungle strategies, right? And that's the cost segregation. I can't say enough about how well this strategy works, how many thousands of dollars. It's just one that the IRS is just giving to you. And there's so much that you can take advantage of. It's beyond words. So we start off with the cost segregation, right? So let's say about 25% of the property, including land, is reclassed as a 5, 7, and 15-year property, right? So what we're doing is we're taking that long-term depreciation that we're allowed with the 27.5 years, which comes out to almost nothing. It is something, but it's not considerable, right? It's not gonna make a big dent on the taxes when you do it that way. So, but what we're doing is we're taking that long term and we're shortening it, okay? So then we can put a lot more money on the front end, okay? That in different words, that's how it works, right? And this is all legally, by the way. This is all just following the tax code. But like everything, right, the nuance is you have to do a cost segregation study. It's not just you showing up at the property and, okay, so this is that. No, you have to do an engineer study. But it's just a few $1,000s worth of hundreds of $1,000s of savings. So it's a complete no-brainer. But so for the $700,000 investment, we spoke about 25% that we're able to shorten it. That comes into about $160,000 in short life property. So think about that, right? That's basically taking the difference between doing the $700,000 that we purchased, dividing it by 27.5, which comes out to a few $10,000, a few amount there, versus $160,000 that we're able to put in at the front end. Just think about that, right? And if you want to learn more about the cost segregation, just go back to my video. I have specifically how this works. But for staying here in our short-term rental discussion, we make that we make it work, right? We make that strategy work. We go in with the cost segregation, where we do $160,000 on the depreciation. So we got the cost segregation. So with 100% depreciation back under the new tax bill that just came up, the $116,000 can be expensed on year one. That's what we talked about, the cost segregation, right? Assuming that it was placed in service in 2026, right? That's important, and that the short-term rules are met, right? That everything that we discussed previously, we check the boxes. If you're working with us, we're gonna be able to do. The total paper loss on that year can be about $175,000. You heard me right, $175,000 of losses. Okay, so if you're in the, let's just say, the 37% bracket, that's about $65,000 in tax saving. To be exact, it's somewhere about $64,750. Even though the property cash flow wise is breaking even. You heard me right. You're actually investing, you're actually making an investment in a property. When you're talking about cash, you're about breaking even, but in the books, you're having a $65,000 loss. I mean, in terms of tax strategy, this is the king. And even better, if you do this right, and we meet the requirements for the short-term rentals, guess what? That's gonna all that loss is gonna offset your W-2 income. I mean, that's pretty much. I mean, that's a golden rule. That's one that it's we can't say enough about it. It's beautiful. It's all legal. It's backed by tax code. The tax code is very clear. It's not one of those tax codes that it seems to be gray area where you don't know which direction you're going. This is an ironclad strategy. But you do have to follow the rules, right? Just like everything. It's a strategy that comes in with the caveat that you have to make sure that you follow very simple rules. We're not talking about, having to kind of just, go and reinvent the wheel to make this happen, right? But, to use it correctly, like the code's reading, so just to kind of give you a summary, right? So it's average stay of 7 nights, of about seven nights, as I mentioned. They personally meet the material participation test, or you do the additional work that you can add it there to make it more of a hotel type of service, but there's some caveat to that, but just generally speaking, that's how it works, right? So I gave you that example. So let's just sort of go back and talk about like how we go the different steps, right? So we talked about there's the short-term rental, right? We do the analysis, we do the formulas, we fall under the 7 days or less, right? What do we do next? What's the depreciation, the cost segregation, the 170? Like, what do I do next? Okay, so one step at a time, right? So we got the short-term rental math all figured out. Then we go over our next step, which is the regular depreciation versus the short-term rental advantage, right? Which what we talked about. So under the normal depreciation, we get 27 years and a half, right? So it's just a straight line, simple math. You do in the example I explained earlier is the 700,000 that you divide by 27 and a half. That's the, kind of considerably, low number, especially compared to the cost segregation amount, right? But if the short-term rental is treated as a business, And so then we can use the cost segregation and bonus depreciation to front load all that beautiful deduction, right? So, cost segregation is an engineer study we talked about, and then it identifies the furniture, appliances, carpet, cabinets, fixtures, 5 to 7 years. Then it does the sidewalks, the parking lots, landscaping, all that within the 15 years. And then with 100% bonus depreciation, those short-term life assets can often be fully deducted on year one. So often, because you have to make sure that they follow, that they are within, that every one of those meets the criteria to be the either 5 to 7 years or the 15 years. If they follow and they meet that requirement to be that type of asset, you are good to go. You can commingle all of that, and that's when you make the division, it turns that 27 and a half year length or time into a shorter time that you can upload at the front end. Okay, so I'm trying to explain it in the most simple way that I can, to just kind of at least put some graphic and illustrate how it works, right? And all that is done legally. All of that is with support, as I mentioned earlier. If this is done right, it's exactly as I'm describing it, right? And then you get your section 179, right, on appliances and furnishing, right, and furnitures, right? So basically, the way it works is, I don't want to confuse you with too much technicality, because now we're getting into the kind of the weeds of now getting very technical. But besides the cost segregation, you also get section 179 options. Besides that, I can add money into that front load deduction at the front end, to just basically squeeze the most that you're legally allowed on year one, right? And then obviously this is kind of a part of the whole planning, right? Because if you're doing this math correctly, and you're kind of just looking at your whole situation, and whatever other assets you have, whatever other income you have, whatever other passive or active losses you may have, all of this is part of a combined strategy, right? Because it may make sense to take all this deduction on year one, but it might make sense to you that you don't use the 179 on year one, because then some of those deductions are that you can allocate them on year one, and some of them you can carry them over for future years. Some of them you have to use them on year one. So there's a study there that you need to do. It's just, we make it simple here for your upfront CPA. We give you exactly what you will need on year one, which of these deductions might work on your situation, because as I mentioned, if you have other losses, you have other income, it might make sense to put a hold on doing that required front load on year one, and carry over some of that year two, when you might have bigger or more income down the road. So this is part of a bigger strategy that we work with you, right? Yeah, so like I said, it depends on your income, depends on your long-term plans. It's just not doing it blindly, right? It takes some focus, it takes some experience, it takes asking the right questions on both ends, right? From the CPA to you as a taxpayer, and you as a taxpayer asking also the right questions, so that you guys work together to kind of make this work, right? So now that we know with the short-term rentals, now that we know the added bonus there of the 100% depreciation, now that we kind of have those ducks in a row, now let's talk about like some of those short-term rentals deductions that sometimes are often missed, right? And so just kind of like, I'll just give you a rapid fire, right? Premium. They basically have the premium list, right? So appliances, furnitures, and decor, some of these can be expensed via 179. We're allowed, we already talked a little bit about that, repairs and maintenance, not capital improvements, right? Because, it's the the famous, is it capitalized or not, right? So that's when you kind of need that technical advice from your accountant, right? The cleanings and linen, the cleanings, right? The supplies and other repairs with with certain supplies, software and platforms, travel to and from the property. So mileage, airfares, Ubers, all of that, that kind of falls under that travel, depending on how close or how far that short-term rental is. Property taxes and mortgage interest, some people forget about that. And paying family members, right, for legitimate work. So that's another big one, right? So if your cousin is a landscaper, if your brother-in-law is a marketing expert, social media, admin, accounting, so all of that can you can work with your CPA to make sure that you're getting the right type of deductions, right? And then another big one that we see mixed is the QBI, right? Which I have another video on the famous QBI and how it works, right? So, and basically how that one works, and you can go back and see more details, but just to kind of give you the general definition, it's just basically you get to take off to deduct 20% of your qualified earned income as a business onto your personal filings, right? Obviously there are some thresholds, there are some caps, but if and we'll get more details. If you look at my earlier video, you can just see more details about the caps and the threshold. But if not under the threshold, it's a beautiful deduction that you can take advantage. Another 20% that you get off of your as a tax savings. Okay, so now that we know that, we move into the next one, the next big one, right? Which is often one of the first questions that I get asked is, okay, so what's the IRS red flag? What are the IRS red flags? Please tell me, like, what do I need to do so that the IRS doesn't come knocking? Okay, so I'm just gonna summarize a little bit of kind of sort of like the mistakes that you want to avoid, because they kind of put you in the front row there of putting yourself in a situation where you're kind of a look at me situation that can cause problems for you. Okay, so if average stay is actually, like, let's say 9 to 10 nights a day, but treating it as 7 or less. Okay, so that's basically doing the math that I talked about. Is it doing it correctly? And as I've mentioned a couple of times, is you can work proactively to avoid the situation. Okay, outsourcing property managers, right? It's a big one. If you're paying someone to take care of everything, but then you're saying that you're materially participating, it can be a problem, right? And they can easily track this. Even if you're paying management company, if it comes out of the books, and it's clearly a management company, or you're saying that you participate but you have logs, somebody's obviously taking care of everything and it's not you, that can be a problem, right? Excessive personal use, it's another one, right? If you use it too much as your own, then it's not an investment, it's really for personal use, right? So not another one that you have to consider. Okay, so no separation of business personal bank accounts. This is a huge one, right? Commingling funds, it's a no-no. It just takes like maybe a half a day at the most to just go to your local bank, show them that you open up show them that you have a business, you have our Airbnb, just create a bank account for that. Our recommendation is, if it makes sense, open up an LLC, have the property owned by that LLC. You can go to the bank, you can open a business account, but worst case, just create a separate bank account for this rental. You should be good to go. Okay, so taking huge first-year losses without any documentation, right? So again, you can do all of this, but if you're missing proper documentation, if you're missing backup, if you don't have support, that is when the problem comes. Okay, so all of these strategies come with the understanding that you have at least some basic knowledge of certain things that you have to take care of, and one of them is just keeping logs, is keeping documentation. It's one of those things that seem hard at first and just seems like a hurdle that you have to kind of it's an inconvenience, but at the end of the day, once you see how much you're saving, it's gonna be no worries at all. Okay, so so I kind of gave you the layout, right? And one important thing here is once you create you follow all the structure correctly, you do everything right, you do the math correctly, you have your Airbnb, you do the work yourself, you materially participate, you follow everything that I just discussed, okay? It doesn't mean that you are free from, getting a letter of documentation. So it happens, right? People, it's sort of random also how audits work, right? But we always like to kind of talk to our clients that whenever you're gonna do a strategy like this, just always assume that you might have to defend it. I feel like when we work with our clients under this structure, it helps them because it puts the urgency on their end to you're saving thousands and thousands of dollars, right? So it just takes a considerably, let's just say it's granted that it could be considerable work, especially if you're not used to it, but at the end of the day, it's huge savings. It's totally worth your time, and you're gonna be so happy that you had it that you're gonna be jumping down with joy. Okay, so I'd like to thank everyone for taking the time and sticking with me. Again, here at Upfront CPA, we like to educate. We like to share with our clients. Examples of how things work, how some of them didn't work. But if you yourself, if you're thinking about, a short-term rental, if you think it's something that, with everything I just mentioned, it's something that a strategy that could work for you, give us a call. Let's book a strategy session. Let's just have a conversation. You never know where that could take. And, you don't even have to call us. Just call your local CPA. And you'll be surprised, just how much you'll be able to save using this or any other strategy. So I'd like to thank you again for sticking with me for this whole time, and we'd love to see you again.